Welcome to Big Picture Earnings Analysis. Today we're reviewing the Q3 fiscal year 2026 results from Okta.
We've seen some really solid results, but also a bit of caution in the forward look. Let's just unpack this right away.
Okay, let's start with this third quarter. It ended October 31st, 2025. What were the key headline numbers that, beat those analyst estimates?
The results were generally ahead of expectations.
Yeah.
Total revenue came in at $742 million.
Which is up about 12% year over year.
Exactly. And the subscription part of that, which is almost everything, was $724 million, so up 11%.
But the real story was the earnings per share, right? The profitability.
Oh, absolutely. The non-GAAP EPS was 82 cents adjusted. That was notably ahead of the 76 cents analysts were looking for.
So beyond just the revenue, the cash generation looks particularly strong this quarter.
It does, and this really reflects, I think, a new level of efficiency.
Okay.
Free cash flow was $211 million. That gives you a free cash flow margin of 28% of total revenue.
And that's a pretty big jump from last year.
A huge jump. It was $154 million, or a 23% margin, in the same quarter last year. So they're definitely getting more efficient.
And that ties into the operating margin.
It does. The non-GAAP operating margin hit 24%, which is up over 3 percentage points from the previous year.
And they hit that so-called rule of 40.
They did. The combination of their revenue growth and that free cash flow margin reached 44%.
So on paper, a really strong quarter.
A very strong quarter. But, and this is the big but, this is where it gets interesting, the outlook.
Right. So this is where we need to focus, the guidance. What did management actually say for the current quarter and the rest of fiscal year 26?
Well, they used the phrase prudent approach themselves.
Which is usually code for we're being conservative.
It is. So for Q4, they're projecting total revenue between 748 and 750 million. That's only 10% year-over-year growth. A bit of a slowdown.
Okay, and what about the near-term backlog, the cRPO? That's the key indicator.
And that's where the caution really shows. They're projecting cRPO growth of just 9% year-over-year.
9%. That is a noticeable step down from the 13% they just posted.
It is. But on the flip side, profitability guidance is strong. They're expecting a 25% non-GAAP operating margin and a free cash flow margin of about 31%.
So the full year picture is more the same, raising the profit outlook.
Exactly. They raised the full year non-GAAP operating income guidance to between $753 and $755 million. That's a 26% margin.
Okay, so they raised the profitability outlook, they beat Q3, yet we saw the shares fall in the news. What does this all mean for the stock?
It comes down to expectations. The market was looking for more than just a good quarter. The stock fell because the company explicitly did not provide preliminary guidance for the next fiscal year, FY27.
Ah, so they created an information vacuum.
Precisely. The finance chief cited seasonality and the need for some conservatism as reasons to hold back.
And the market just fills in that blank with the worst case scenario.
The market hates uncertainty. So yes, that's what happened.
Let's look beyond those short-term numbers then and dive into what's actually driving the growth. I'm thinking large customers, new markets.
Yeah, and the growth is really consolidating around those larger customers.
Okay.
The number of customers spending over $100,000 in ACV grew 7% to about 5,000. And that cohort represents over 80% of their total annual contract value.
So the business is very reliant on those big fish.
It is. And the biggest of the big fish, the one spending over $1 million a year, that group grew 17% year over year to 520.
Wow, so that's where the real growth is coming from.
It is. And that group alone represents over $1 billion in total ACV for them. Also, the dollar-based net retention rate held steady at 106%.
So existing customers are still spending more, which is a healthy sign.
It's a very healthy sign in this environment.
Now, the CEO spent a lot of time emphasizing AI agents as a key growth area. How is Okta actually positioned to, secure this big technology transformation?
Well, they launched a product called Auth for AI Agents in Q3. And the CEO made a pretty bold claim.
I saw that. He said the upside from securing AI agents could potentially exceed their current market, which is already estimated at $80 billion.
It's a massive claim. But the logic is that it's not just about securing human identities anymore. It's about securing all the non-human ones.
So things like service accounts, virtual machines, all that back-end stuff.
Exactly. AI agents, OA youth tokens.
Yeah.
All these things need to be secured and governed. And their platform, things like Okta Identity Governance or OIG, are designed to do just that.
So they're trying to become the identity layer for this whole new world of automated systems.
That's the pitch, and it's a compelling one.
We also saw some specific mentions of the competitive landscape positioning themselves against, the giant in the room, Microsoft. What should we take away from that?
I think their messaging is getting really sharp here. It boils down to two things: reliability and neutrality.
Okay, let's start with reliability.
They put out a pretty stunning statistic. They claim they had only 69 minutes of outages between 2021 and 2024.
69 minutes over 3 years.
Right. And they compared that to Microsoft, who they say had over 2,100 minutes of outages in that same period.
That's a powerful selling point. If you're a big enterprise, identity can't go down.
It can't. And then on the security and governance side, they're leaning on third-party validation.
The Gartner reports.
Exactly. They were named a leader in the Gartner Magic Quadrant for Access Management for the 9th consecutive year. And they made a point of saying they placed higher than Microsoft in all 5 use cases on the Critical Capabilities report.
So the argument is that Microsoft is good enough for a Microsoft-only world, but if you have a complex multi-vendor setup,
You need a neutral best-of-breed partner. That's the core of their competitive strategy.
let's circle back to that profitability theme. The jump in cash flow and operating margin, it implies really tight control over expenses.
It does. Their non-GAAP total expenses only increased by about 7% year over year, which is pretty impressive when revenue is growing at 12%.
And that's how you get that margin expansion.
Right. They said it was due to a continued focus on spend efficiency measures, even while they keep investing. Total headcount, for context, was about 6,270.
Okay, but for our listeners who appreciate the precision here, could you just clarify what they are excluding to get to these great non-GAAP numbers?
Of course. This is really important. Non-GAAP metrics exclude several pretty significant non-cash expenses. The biggest one is usually stock-based compensation.
Which is a real cost to shareholders through dilution, even if it's non-cash.
Absolutely. They also exclude things like the amortization of acquired intangibles, which is still a factor from the big auth deal, and other acquisition-related expenses.
I see.
And they also use a fixed long-term tax rate of 26% to calculate their non-GAAP net income, which just provides more consistency than the fluctuating GAAP rate.
What's really fascinating here, though, is their cash position. They are clearly generating a lot of capital while still growing.
The balance sheet is very robust. They're anchored by $2.46 billion in cash, cash equivalents, and short-term investments.
And they put some of that cash to work this quarter.
They did. They settled the remaining principal amount of their 2025 notes, paying off $510 million in cash.
A $500 million debt payment. That sends a strong signal.
It does. It shows they're de-risking the balance sheet. They're being prudent, just like their guidance.
So we've covered a strong beat on revenue and especially profitability for Q3, alongside what seems to be some cautious but still positive guidance for the rest of fiscal 26.
And if you connect this to the bigger picture, the company is managing its debt. They settled that $510 million in notes. They still have $350 million of the 2026 notes outstanding.
And management said they'll be opportunistic with repurchases going forward.
Exactly. So here's the thought for you to consider as you digest these results. With that significant cash reserve and really strong free cash flow, how will that influence their capital allocation strategy in the coming quarters?
Will they buy back more debt? Or maybe make another acquisition to boost that AI story?
That's the multi-billion-dollar question. That's what you need to be thinking about.
Thank you for joining this big picture earnings analysis.